Welcome to Griffonomics.
Yeah, glad to be here.
So imagine being so incredibly confident in your company's future that you just go out and borrow $20 billion.
Right, which is just a staggering amount of money.
Exactly. And you're not doing it to fix a failing business, but to buy a completely new identity, because that is exactly what Abbott Laboratories just did.
It's really a massive pivot. I mean, they are taking this deeply entrenched structure that was built for predictability and basically injecting it with an incredible amount of aggressive growth.
And that right there is our mission for this deep dive today. We are unpacking Abbott's fundamental real-time transition from a very steady, diversified healthcare conglomerate into what is becoming a dominant high-growth force in cancer diagnostics.
Yeah, it's a huge shift.
It is. And to really get into the weeds on this, we've pulled together a massive stack of materials. We're analyzing Abbott's 2025 annual report, their freshly released Q1 2026 earnings, some really complex legal landscape briefs, and detailed analyst reports from Seeking Alpha.
Which, when you put it all together, paints a totally fascinating picture of a company in total flux.
Oh, for sure. And for you listening, here's exactly why this matters to you. Whether you are an investor looking for a value play, or you're just someone trying to dissect high-level corporate strategy, this deep dive is going to reveal how a massive $21 billion pivot is currently causing a 10-year valuation anomaly in the market.
Because that $21 billion shift is creating immense friction right now.
Right. But before we get into the shiny new oncology stuff, I feel like we really need to understand the baseline structural foundation of the company.
Oh, absolutely. You don't make a $21 billion bet unless your core business is, practically bulletproof.
So let's look at that baseline. In their Q1 2026 earnings, they outline what they call the 4 pillars of health.
Right, the 4 pillars.
Yeah. And it's an incredibly diversified revenue stream. Just in the first quarter alone, medical devices brought in $5.5 billion. Diagnostics generated $2.2 billion. Nutrition stood at $2.1 billion. And established pharmaceuticals added another $1.4 billion.
And the sheer mechanics of those 4 pillars operating all at the same time is really what creates their economic moat.
Yeah.
And it's not just diversification by product, right? It's fiercely geographic. We're talking about a company with 122,000 employees operating in over 160 countries.
Which is just wild scale. And when you look at how it functions, it's almost like a localized insurance policy.
How do you mean?
Well, I like to think of Abbott's business model as a massive 4-engine jumbo jet.
Okay, I like that.
Right? So if you're flying over the Atlantic and one engine temporarily loses power, say the nutrition segment hits some sort of supply chain snag in a specific region, the other 3 engines just keep the plane flying at cruising altitude.
Yeah, that makes sense.
The passengers, or in this case, the investors, they are completely insulated from a localized crash.
That's a perfect analogy. And the geographic spread is really the key to that insulation. Because if a competitor disrupts a specific medical device market in Europe, well, Abbott's generic pharmaceuticals in Latin America are still pumping out cash to stabilize the balance sheet.
Right.
They are never overly reliant on a single therapeutic area or, a single government's healthcare budget.
Which gives them tremendous freedom. And that exact baseline stability is what gave management the financial confidence to execute the aggressive, transformative acquisition we're about to talk about.
Exactly, because you don't just write a check for $21 billion unless you know your 4-engine jet can handle a massive amount of extra weight.
So let's talk about that extra weight, because it feels like Abbott just bolted rocket booster onto that jet.
They really did. And that happened formally on March 23, 2026, when Abbott closed the monumental Exact Sciences acquisition.
$21 billion.
$21 billion. And this formally establishes Abbott's entry into the precision oncology total addressable market, which is roughly a $60 billion space.
It's a massive total addressable market. But wait, what exactly did they get for all that money? They didn't just buy a few test tubes, right?
Oh, no. They bought a portfolio that literally changes how oncology operates. They established an entire precision oncology vertical.
Right.
So first, you have Cologuard, which is the market-leading non-invasive colorectal screening test. Everyone knows Cologuard.
So you see the commercials everywhere.
Exactly. Then you have Oncotype DX. And this one is incredible. It analyzes the genetics of a breast cancer tumor to tell doctors if a patient actually needs chemotherapy.
Wait, really?
Yeah, or if they can safely skip it altogether based on their specific genetic profile.
That's amazing. And they also picked up CancerGuard, which is that multi-cancer blood test.
Yeah.
But I really want to talk about Oncodetect.
Oh, yeah. The science on Oncodetect is fascinating.
It really is. It looks for what they call molecular residual disease.
Right, MRD. So basically, after a patient has a tumor surgically removed, the biggest, scariest question is always, did we get it all?
Yeah, of course.
So Oncodetect searches the patient's bloodstream for microscopic, lingering fragments of tumor DNA. It essentially finds the cancer before it can form a new tumor, which completely changes the timeline for medical intervention.
It's incredible tech. But, looking at this from a business perspective, the real genius isn't just the science, it's the recurring revenue model.
Oh, absolutely.
I mean, look at Cologuard. 25% of those tests are 3-year patient rescreens.
It basically operates like a subscription model for cancer screening.
Exactly. And even more importantly, they are strategically integrating these tests directly into Flatiron Health's OncoEMR platform.
Yes, the OncoEMR integration is the hidden multiplier of this entire deal.
For sure. Because OncoEMR is the electronic medical record system used by over 1,600 community cancer centers, right?
Exactly. So by integrating directly into that software, Abbott gives thousands of oncologists direct digital access. It makes ordering these specific tests a seamless one-click process within a doctor's existing daily workflow.
It's like they bought the toll booth on the only highway into town.
That is exactly what they did. They removed all the friction.
But I've got to push back here for a second because I have a really big question about this strategy.
Hey, let's hear it.
Isn't a $21 billion price tag a massive gamble for a company that is famously known for steady, incremental innovation? I mean, why buy a whole new company instead of just building this diagnostic tech in-house?
That is the big question. But the reality of modern medicine is that Abbott is buying time and market dominance.
Buying time.
Yeah, building something like Cologuard in-house requires years of grueling R&D. And then you have the incredibly unpredictable multi-year FDA approval phase.
Oh, right, the FDA bottleneck.
Exactly. By paying the premium for Exact Sciences, they skip that entire phase. They bypass the developmental risk and immediately capture $3 billion in expected incremental sales for 2026 alone.
So they just bought their way to the front of the line.
They absolutely did.
But, I mean, that massive $21 billion price tag doesn't just exist in a vacuum. It has a direct, immediate, and honestly painful consequence on Abbott's current balance sheet.
It definitely does. Which brings us right into the Q1 2026 financial realities.
Right. And looking at the numbers, there's this crazy disconnect between the top-line health of the business and the bottom-line reality of this acquisition.
Let's look at the top line first because they are doing great.
Yeah, the top-line momentum is undeniable. Q1 2026 global sales hit $11.16 billion. That's an impressive 7.8% reported increase.
They actually beat Wall Street expectations by $160 million.
Right. The core engine is humming. But to fund the Exact Sciences acquisition, Abbott had to take on a massive $20 billion bridge loan facility.
Wow.
Yeah. And on top of that, they absorbed $1.8 billion of Exact Sciences' existing net debt.
That is a staggering amount of leverage to drop onto the balance sheet all at once.
It is, and that financing causes a very real 20-cent adjusted EPS dilution. And just for anyone listening who might not follow the acronyms, EPS is earnings per share. When a company takes on massive interest payments for a loan, it eats into the actual profit that gets divided up among the shareholders.
Precisely. And because of this dilution, management was forced to adjust their guidance. They lowered the full year 2026 guidance range down to $5.38 to $5.58.
And Wall Street did not like that.
Not at all. That specific guidance cut is exactly what caused the stock to drop to a 52-week low.
It makes sense, though. It's like deciding to install a high-end solar panel system on your house.
Right.
The upfront cost severely drains your bank account today. You have to take out a loan, and you feel temporarily poor.
Right.
Right. That is the diluted EPS.
Yeah, the upfront pain.
Exactly. But the long-term recurring energy, the future revenue from all these oncology tests, it basically sets you up for decades.
That's exactly how management is viewing it. The market is currently punishing Abbott for short-term margin compression. I mean, gross margins fell to roughly 56.3%.
Which hurts.
It hurts today, yes. But this temporary pain is just the necessary friction of a long-term strategic evolution.
Okay, so while the stock market is totally obsessing over the short-term oncology price tag, I feel like they're completely ignoring the fact that Abbott's legacy growth engines are quietly firing on all cylinders across the globe.
Oh, they definitely are ignoring it, especially when you look at medical devices.
Let's talk about medical devices because it is the absolute growth engine right now. They posted a 13.2% reported growth rate in Q1 2026.
Double-digit growth for a division that size is phenomenal, and that dominance is really being driven by electrophysiology.
Right, electrophysiology grew by 12.5%.
Right.
That's largely due to their new Volt PFA system and the Tactiflex Duo catheter launches.
Yeah, and we should probably unpack what PFA actually means.
Yeah, please do. Pulsed field ablation.
Right, exactly. Pulsed field ablation represents a massive leap in cardiac care. Historically, if someone had an irregular heartbeat, doctors used thermal ablation. They'd use extreme heat or extreme cold to essentially scar the heart tissue that was misfiring.
But the danger there is collateral damage, right? Because the esophagus is right next to the heart.
Exactly. You run the risk of damaging surrounding tissue. But the Volt PFA system changes that entirely. Instead of temperature, it uses incredibly brief, high-voltage electrical pulses.
Okay.
And the revolutionary part is that heart muscle cells are highly sensitive to these specific electrical pulses, but the surrounding tissues, like the esophagus, are completely resistant to them.
Oh, wow. So it selectively targets the problem cells without burning anything else.
Precisely. It's safer, it's faster, and that's why we're seeing such a massive surge in hospital adoption.
That completely explains the 13.2% growth.
Yeah.
And it's not just cardiac care either. Their diabetes care evolution is massive. The Freestyle Libre system brought in $2.028 billion this quarter.
It's an absolute juggernaut.
And they just integrated generative AI into it with Libre Assist. Plus, they had that huge success with the FreeDM clinical trial.
Right. The FreeDM trial was a huge win. It basically proved that the Libre system delivers better outcomes for type 2 diabetes patients who only use basal insulin, which opens up an enormous new demographic for them.
So the domestic innovation is clearly there, but we also have to talk about the emerging market engine.
Right, the international reach.
Yeah, because their established pharmaceutical segment grew 9.0% on a comparable basis, primarily driven by Latin America and the Asia-Pacific region.
Which is a huge part of their identity. 61% of Abbott's overall sales originate internationally. That defines its true global scale.
But I've got to ask a critical strategic question here.
Go for it.
Given that 61% of their sales are international, doesn't this massive global footprint actually expose them to a whole new set of vulnerabilities? Like, what about foreign exchange risks or foreign government price controls?
Oh, it absolutely does. It's
Yeah.
a very valid point. Global scale is a total double-edged sword, and we are seeing that exact vulnerability play out right now in China.
Oh, with the VBP programs.
Exactly. Volume-based procurement. Abbott is facing severe pricing pressures in China because of this.
Can you explain how VBP actually works? Because it sounds brutal for margins.
It is brutal. Essentially, the Chinese government acts as a single massive buyer for public hospitals. They tell the medical device companies, if you want access to our market, you have to slash your prices.
Like how much?
Sometimes 50, 60, or even 70%. The company that bids the lowest gets the volume contract, and everyone else is just locked out.
Wow. So it forces Abbott into this intense race to the bottom on pricing. It really proves that international scale requires constant maneuvering.
It really does.
But, speaking of vulnerabilities, no matter how well their international devices are selling, we have to look at the very real domestic threats that are actively draining capital and investor confidence right now.
Yes, we need to talk about the cracks in the hull.
Exactly. And just as a crucial note for everyone listening, we are remaining strictly impartial here. We are not taking the side of the plaintiffs or the corporation. We are simply reporting the legal facts and the verdicts exactly as they are stated in the source briefs.
That's an important disclaimer, because the NEC litigation overhang is a massive issue. Abbott is currently facing over 1,700 lawsuits claiming its Similac preterm infant formula causes necrotizing enterocolitis.
Right, NEC. And the recent state-level verdicts have been staggering. They were hit with a $495 million verdict in Missouri and a $70 million verdict in Chicago.
$500 million in a single verdict.
But here is the shocking financial reality that I saw in the reports. Abbott has currently recorded zero financial reserves for these lawsuits. They are maintaining that a material loss is not probable.
Which is fascinating from an accounting perspective.
I mean, let me push back hard on this. They've been hit with $500 million in single verdicts, and they haven't set aside any financial reserves. Are they overly confident, or is this just high-stakes legal posturing?
It's heavily strategic legal posturing. You have to understand the corporate rationale here. If Abbott suddenly takes a massive reserve, say they set aside $1 billion, plaintiff attorneys in the other 1,700 trials will use that.
Oh, I see.
They'll point to that reserve in front of a jury and frame it as an admission of liability. They'd argue, look, they know they're guilty. They already set aside the money to pay us.
Wow, okay. So by refusing to reserve the funds, they protect their legal defense. But doesn't that just create a massive unpriced risk for anyone holding the stock?
It creates an enormous unpriced risk. The market hates uncertainty, and right now, investors have to guess what this will ultimately cost.
And that uncertainty is piling on to what the analysts are calling the nutrition sputter.
Right, the nutrition segment is struggling. We saw a 6.0% year-over-year revenue decline in Q1 2026, dropping it down to $2.0 billion.
They're dealing with lower volumes, and they're basically hoping that strategic pricing adjustments will trigger a second-half recovery. And then, on top of all of that, you have the ongoing U.S. tax court dispute with the IRS over $1 billion in additional taxes.
So when you stack the Exact Sciences debt, the VBP pricing pressures, the NEC litigation, and the IRS dispute, you can see why the market is so incredibly skeptical right now.
It's a lot of headwind.
Yeah.
So let's distill the ultimate takeaway for the listener here. With all of these factors at play, where does this leave Abbott's valuation?
Well, according to the analyst reports, they rate Abbott as an accumulator or a value play.
Because of the short-term EPS dilution from the Exact Sciences deal and all that legal overhang, the stock is trading at roughly 17.7 times forward earnings.
Exactly. Which makes it the most attractive valuation in a decade for a dividend king.
But with a major caveat, Rose.
A huge caveat. It is only a value play provided the investor has a multi-year horizon. You have to be willing to stomach the unreserved legal risks and wait for the oncology pivot to actually pay off.
Right. It's a long game. But before we wrap up this deep dive, I know you had a final, really provocative thought you wanted to leave the listener with regarding this whole oncology shift.
I do, and it's something I think everyone should ponder on their own. As Abbott rapidly pivots from generic diagnostics into highly personalized precision oncology, they are gathering oceans of data.
With tests like Cologuard and CancerGuard.
Exactly. So the lingering question is this. How long will it be until the massive amounts of genetic data they gather from these tests become fundamentally more valuable than the diagnostic devices themselves?
Oh, wow. So the data becomes the true asset.
Precisely. In the future of predictive medicine, having the genetic blueprint of millions of patients might be the most powerful economic moat imaginable.
That is a fascinating angle to watch as this all unfolds over the next few years.
It really is.
Well, that wraps up our analysis on Abbott Laboratories. Risk defined. Portfolio protected.